Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. All right, everyone, we have got a special breaking news episode of Expansive CEO podcast today with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies, to talk about what's happening right now with Silicon Valley Bank, which just went into what's called FDIC receivership, which means the bank failed yesterday on March 10th. Today is Saturday, March 11th. And so, last time we had a big bank failure like this was in the 2008, 2009 time frame with the Great Recession, and a lot of people are, rightfully concerned about what this means for the overall economy. Like, oh, that's a big bank failure. Why, what should we be looking for? Why did this happen? So we're going to try to answer some of those questions for you today, including, what does that potentially mean for the stock market going forward? So first, Brad, tell us, what is a bank failure? And, what does that actually mean in terms of like the investor, not even investors, the people who had deposits in that bank at Silicon Valley Bank?
Okay. So a bank failure is just that. It is essence when they don't have enough money to continue operations, meaning you want to write a check on your account to withdraw some money and they can't provide the cash to you to make that withdrawal. That's when the bank fails. They fail their duty as a financial intermediary where they take in deposits and loan money out. So what happens is there's state and federal regulators that step in. You mentioned the Federal Deposit Insurance Corporation will step in. FDIC will step in and place the company into receivership, meaning they're now running the company. They're now running the bank. They're responsible for funding the loans, collecting the interest payments, paying the employees. They're responsible for literally opening the doors on Monday morning for the customers of what was formerly known as Silicon Valley Bank. So that is a classic bank failure. Mm-hmm. Now, what does it mean to the average depositor? Okay. For us sitting here, we're thinking in terms of individual investors or individual depositors, where our households have checking accounts and savings accounts at our bank. We may have a mortgage, we may have an auto loan, maybe a credit card or some other type of revolving debt. That's very different from what Silicon Valley Bank did. Silicon Valley Bank made their name over the last 40 years in banking technology startups, fast-growing technology companies where they specialized in providing banking relationships, but also some other ancillary services to those individuals or to those companies. So it's a little different than what, as we sit here as individuals, thinking how that would impact.
Yeah. Now, one little detail I wanted to mention here, that so people kind of get the scope of the difference here, is that with like Silicon Valley Bank, like you mentioned, they were mainly funding the tech sector. Like a lot of venture capital was deposited. So if you think about a young tech startup company and they get, $100 million in funding, they need to put it somewhere. A portion of that they would put, like, that's the kind of stuff, the kind of money that Silicon Valley Bank would get on their deposit sheets, that these tech startups would place their money there. One article that I read by Ken Sweet of the AP was saying that Roku had like $427 million of cash on deposit at Silicon Valley Bank. And so, Brad, we can mention again
Well,
that
it's
any stocks, any like companies that we talk about, this is purely informational. This is not any sort of buy, sell, anything recommendation. This is purely information. But yes, so it's not like you said, not like if I have my personal savings account at some bank. This is like big companies with a lot of money on deposit in large chunks. Does that
yes,
help?
and perfect. And they did a fantastic job, by the way, for 40 years. Okay. Um, and I think they've been one of the main banks in helping develop the tech sector. So it's they've done a, in certain ways, they over their history, they've done a pretty decent job. They made a few mistakes, obviously, which we'll discuss a little later. But if you want to stay with Roku as an example, again, not a solicitation to buy or sell Roku. It's just an example of what's going to happen is $250,000 was FDIC insured.
Mhm.
So that money is good to go. It's Roku's money. The problem becomes is any dollar over that limit becomes an unsecured creditor of Silicon Valley Bank. So what does that mean? That's a big name for just a person that kind of has to wait in line to see how the FDIC runs the bank, liquidates the assets, pays off their loans, and then obviously depositors are fairly high in the capital structure. So the FDIC is going to do their best to pay as much as possible to those depositors who are uninsured, who have exceeded that insurance for their assets. So and we're going to talk a little bit about how problematic that could be for some of those companies, in at least in the short term. Um, so that's kind of how they'll be treated.
Yeah, and so that's again, that really opens up that conversation again, right? Because it's like 420 something $1 million is a lot different than, your grandparents having 250,000 or $500,000 at a local bank. So, yeah, that's a big asset to have to, figure out how much are they going to be able to get back, and then what does that mean, for all the companies who are in that same spot. But what happened with the bank run, right, this past week was that because they serve so many business owners, entrepreneurs, a lot of people couldn't get their money out to make payroll. And so, like this is not just it's not just a bank issue. This does ripple into the economy in some ways. So yeah, it'll be interesting to see how that unfolds over the next week, and what the FDIC is able to, stabilize.
Yeah.
So what you mentioned two things, like, there were two major mistakes that happened in your view, as a financial risk manager. And, those things happened over the last couple of weeks. But what should people maybe have seen coming before? What was SVB doing differently from other, mainstream banking institutions?
Well, they made a classic asset liability mismatch mistake. A couple of really big ones where they ran, so their business model, like we were talking about, tech heavy, very focused in one industry or a couple of industries, um, and having that has some higher risk attributes, like their depository base is not as sticky as, say, a larger bank, okay, that has a lot of individual depositors, and some banks and some companies and some governments that they bank. So that type of banking institution, their depository base is probably a lot more sticky, a lot more stable. When you focus in one area that is fast growing, it's real exciting, but those deposits are not as sticky. They can move very, very quickly, and they're very interest rate sensitive.
Hmm.
So if they can get a little bit more somewhere else, those are what we call hot deposits. They're gone. They're going
Mm,
to the place where the highest return can be had. Similarly, the loans, they can get, if they can get a little bit less in terms of interest expense, they're gone. They're going to refinance that loan. And so Silicon Valley Bank has been very aggressive in those areas. Okay.
mm,
But what the mistakes I think they did this time were, one, they loaded up on a lot of bonds right before interest rates started going up. In
mhm.
fact, about roughly 50% of their assets were in what we call available for sale securities, or securities that they were willing to sell at a certain point. Well, the way you account for those is a little different. Okay. So it doesn't necessarily hit your income statement until you sell it, but it does hit your equity via a category called other comprehensive income. So these unrealized gains and losses are realized through this other category, but it hits their equity on their balance sheet.
So let's talk about that for a second, because that's one of the main differences when you talk about, it just in your listener, in your mind, like think
Mhm.
about your bank that you bank with. That's one of like the, I don't know, top 5 names, just normal banks. When have a mortgage, or when you have deposits on file. No, let's go back to the loan, because that one's the more um applicable one, right? So if you have your mortgage with any normal bank, that is typically accounted for, as like this is, you're going to hold this till the end, right? You're just going to hold, what did we call that? Hold to
Hold to
maturity,
maturity,
right? So
HTM.
that's
Yep. Yep.
hold to
That's a
maturity
category.
accounting. And so most banks have most of that. Is that correct? Like
Correct.
they will usually have hold to maturity, right? Or as a
Yes.
larger portion of their loan portfolio, which means it's a more stable line item on the bank's balance sheet. Is that the right way to say that?
Yes, and the regulators really, if you have bonds that you designate at the initiation or at the inception of that loan or that bond, or that you purchase, either way, and you designate it as hold to maturity, they uh, regulators do not like to see you sell from there,
Hmm.
because they're going to start questioning, well, why was it designated as hold to maturity if you thought you may need to sell that particular security? Okay. Now, just to give you an idea, most banks have a lot of held to maturity category. Okay. It's yeah. So you
And
collect
then,
the interest income, and the unrealized losses and gains aren't really booked into your accounts.
right, you're just taking the interest and you're just holding that until maturity. That's how you stabilize that value of the bond. So if we're doing, say it again, available for sale,
Yes.
instead, the fact that that one piece of SVB's balance sheet was much higher than typical, that's what you're saying was one of the initial orange
Problems.
flags, we'll
Yes.
call it.
So they had 58% of their balance sheet in available for sale securities, meaning they're bonds that they're going to sell at some point prior to maturity of the bond. Now, the how you book the unrealized gains and losses, as they go up and down, as interest rates go up and down, those bond prices go up and down. And so what happens is uh, it's accounted for by, again, unrealized gains and losses going through this other balance sheet mechanism called other comprehensive income, and it's booked directly to your equity section of your balance sheet. It doesn't go through the income statement.
Mm,
Okay. So that's a pretty interesting or pretty important detail,
mm,
because this is where, again, Silicon Valley Bank sold $21 billion. Now, once they sold that, that loss was now booked via their income statement. Okay.
And the loss was what again? How much
About
did they?
1.8 billion.
Okay, so close to
Okay.
$2 billion of a loss that lowered their total
Equity capital.
equity capital of the whole bank.
Yep. So what happens um, is, so that's the second category we have there. The third category is trading security, which it's mark to market. Whatever the price is trading, that's where they market, and the gains and losses go through your income statement. Now, what they did wrong is they had a lot in available for sale, which you have mentioned, but then they also did not hedge the interest rate risk.
Mm.
So they had built this large bond position at when the interest rates were very, very low, 2021-ish. Okay. And in 2022, I'm sure they did not believe that the Fed was going to increase interest rates, greater than 4% in one 12-month period, but they did because they needed to fight inflation. And so generally in that scenario, banks hedge their interest rate risk, meaning it offsets most, if not all, of the value change, the unrealized loss in those bonds. What Silicon Valley did, which is unbelievable to me, is they did not, they actually removed what little hedge they had in 2022. So
Mm.
they're kind of playing from a risk standpoint. They had their business model was inherently more risky than other banks of that size, but then they coupled it with pretty lax risk management, which is inevitably why they went out of business.
So yeah, that's one of the pieces of information that I think people are trying to understand more now, right? Is what does the interest rate hike do to bond prices, right? So when interest rates rise, the value of a bond goes down, right? And so
Yes.
can you,
And
yeah,
here's
can you talk about that a little bit more?
Yeah, so it's real easy to. I'm gonna use a very extreme example just to clarify that point as to why. Because a client or an investor doesn't need to really memorize that. They can just think of an example like, if you bought 2 years ago a bond that pays you 1% and it's going to come due in 5 years. Okay, so it's going to pay you 1%. And then the Fed increases interest rates from 1% to 5%. Okay. Well, you would rather have that 5% interest
Hmm.
rate bond, right?
Right.
Well, if you want to sell this bond, everybody else in the world wants that 5%. So what has to happen to the price of your bond?
It has to crater.
It has to go down. So what happens is the price falls to the point where your 1% interest rate bond yields 5%, or the current yield that's being offered on the market.
Mm-hmm.
So as interest rates go up, again, people prefer to have those higher interest rates. Your price has to go down to compensate for that, which is really, really important for bank managers or bank presidents or chief and financial officers to understand that concept. And I believe they clearly understand that concept, but for whatever reason, they decided not to have interest rate hedges, which is what inevitably took them down.
Yeah, so that's super interesting to think about it in that way. That it's like seems like a very large oversight that should have been in place that could have allowed
It's
them to be okay through this hiking interest rate period.
it's unbelievably incompetent.
Mm.
It's and I don't use that term very often, to be
Right. Strong
frank,
words.
but for someone running a 212 to 220 billion dollar bank, it is it's shocking to people in my industry that they did not have interest rate hedges in place, because that's the normal business operation. That's the normal That's the normal course of business. That's what you do
Mm.
in a bank because of the volatility in those securities during different interest rate regimes. You know, um, so it is really a very difficult for me to understand what was going on. Now, we already talked about their business model was already inherently more risky than most banks. You
Mhm.
can do that all day long if you take care of the risk on your balance sheet. Okay.
Mhm.
You can function for that like that for a very, very long time. Unfortunately, they combined again a risky business model with a lax risk environment, and that's just incompatible. It's literally mutually exclusive.
Mm. So I think this helps explain like the second mistake that you were talking about, which was having sold the securities, sold those bonds, and booked that nearly $2 billion loss. So talk about that a little bit more. That
Yeah,
one led to the other, basically.
yeah. I think that I think part of what I think was the issue, and again, this is just my opinion, is the communication around the financial distress.
Mm.
I think if the CEO came out and said, "Hey," and this is prior to doing anything, if he would have told the investors and the analysts on Wall Street, if he said, "Yes, we're suffering a little bit. Here's the plan how we're going to solve this issue. One, we are going to sell $21 billion from our available for sale bond portfolio. It's going to book a loss. This is the estimated loss." Okay. Two, we're going to make up for that loss in our equity capital by having an institutional investor, a sovereign wealth fund, a very large patient equity investor inject $2 billion into the firm. So their equity would be fairly unchanged. Okay. Unfortunately, what he did is they sold the $21 billion, which I understand why they kind of did that beforehand. But when he said, "Hey, we're going to also sell 2.3 billion in equity," well, once everybody kind of figured out they're under a lot of distress, and he didn't have equity investors backed up already identified and
Mm.
committed, well, then it's you're allowing everybody in the banking industry, your depositors, your clients, your banking peers, they all know it's kind of over. And so I
Mm.
think part of it was a little bit of a communication issue where they did the sale already. They took the equity impairment via the loss, and they didn't have someone already willing to put that 2.3 billion in instantly.
Mm.
Um, it would have been very different had they sold it, and the whoever the equity investor would have been had already put the money in, and then he could have come out and said to everybody, the regulators, to the investors, to, "Hey, we did this to shore up our capital. We took a loss because, again, we didn't have interest rate hedges. The value of these securities went down, but we've made up for it because we've already had an equity injection by this investor." Okay. I think if they had done that, then I think Silicon Valley would have been uh, could have survived it. One of the other things they had, which was early in this week, again, they do a lot of venture funds. They service a lot of venture funds, and they had two very large venture funds tell their portfolio companies, "Hey, Silicon Valley Bank, we don't think they're going to make it. You should be looking to transfer your deposits elsewhere." And
Mhm.
so what happened? They did. They started hitting the transfer button on Tuesday, Monday, Tuesday, and that accumulated into a $43 billion draw on Thursday, which is eventually what took the bank down.
So this is so interesting because I want to pull it into this area for a second, because when we talk about, okay, they had, what was it, over 200 billion, right? Capitalization total
Correct. Yeah, assets. Yep.
of assets. And when we talk about 43 billion came out in deposit,
Yep.
out of like they're taking it out of their accounts. Well, why didn't they have that on the balance sheet? Why didn't they have that available if they've got, over 212 billion in deposits? That's, what people have put in. Well, now 43 billion has come out, and that has like caused the bank to fail. The math, when we hear it just in that way, like the math isn't mathing, but part of the problem, um, I wanted to tie it into Dodd-Frank regulations.
Okay.
Right. And so what's happening with that? Like, why, is the balance sheet so off to where people can't withdraw funds to the amount that the bank says they have on file? Can you talk a little bit about that relationship and the regulations that are in place for
Yeah.
banks?
So again, this is a very idiosyncratic issue with this bank. Not to say there aren't other banks out there that will suffer and be distressed during this time of higher interest rates. It happens during every interest rate cycle that banks that run kind of lax risk protocols, lax policies, lax risk procedures, and they have a little bit more of an aggressive model. And during every interest rate cycle, they tend to go out of business,
Mm,
just because, again, those are fairly mutually exclusive. It's just a matter of time. Um, Dodd-Frank forced banks to raise capital levels. Okay. Now, there's a really critical area, a delimiter or a demarker, if you will, at 250 billion in assets.
mm,
The regulations get much more strict above 250 billion in assets. Now you'll notice they were just below that cap. They
mm,
were just below that marker. So if you are cynical, a little bit like me, then you'll think, wow, they kind of rode all the way to where they think they could not get the higher regulations, the higher requirements, the more require more capital. Um, so they might have ridden that limit. Additionally, the CEO is lobbying pretty significantly about relaxing some of those restrictions on smaller banks so that they could employ more aggressive policies and practices.
mm.
Um, so again, if you're going to be cynical, then you're going to think, wow, that was kind of all orchestrated a little bit, which led to the issues that they're having today. Um, it's uh, Dodd-Frank is there for a reason. I saw a great illustration from JP Morgan Asset Management that took all of the major banks in the United States. They took their tier one capital, which is kind of like, this is your best capital. Okay, patient, it's never not going anywhere. And then they took that capital and they adjusted it for losses on their balance sheet. And most of the U.S. banks are great. They're in
Mm.
great condition because of Dodd-Frank, because of those higher requirements. Okay. Um, SVB did not come out so well,
Mm.
obviously. So it basically all of the loss between the available for sale securities and the held to maturity, if they had to sell those, wiped out their capital to almost zero.
So this goes really well, into this next question of what does this mean for other banks? And you kind of talked about this already in that, if there are other smaller banks who are running these, higher risk profile portfolios for the bank itself, yeah, the way that the Fed is increasing interest rates, that could have an impact on those banks running similar programs. But the bigger banks that we have that are, stable, that are over that $250 billion threshold where they have to keep more capital on hand. Those, tell me a little bit about the stability of the system as a whole.
So there will be some banks that struggle. All banks sold off pretty dramatically this week. I mean, to the likes of JP Morgan, Wells Fargo, Deutsche Bank. I mean, there's a lot of international and local banks that got sold off pretty significantly this in sympathy. Okay. Some of them are fantastic institutions, and they're selling their prices now down through no fault of their own. They run a conservative business. They're great. It's just, I think investors, until they can assess who is running a more risky balance sheet, they're kind of stepping back and saying, okay, who's in the next default, if there is a next default. Now, I don't think, I mean, there may be some other banks that come out and fail or struggle based on kind of a contagion effect, right? Because now investors are looking everywhere,
Mhm.
right? So a Market Watch article came out, and they said these are the 20 banks to watch for. Okay, and so that may be scary if your bank is on that list. So I would encourage someone to call us, call me. Let's do some analysis and figure out whether it's a safer bank or whether it's a bank that is going to struggle. By far and large, most U.S. banks are in good condition,
Mm.
but it's like the analogy with the wave that goes out. Once a tide goes out, you find out who's not wearing a bathing suit, right? Well, the interest rate cycle is that wave that went
Mm.
out to sea, and SVB and a couple of other banks already are the ones to have their unfortunately their day of reckoning. So it's something that it could have a contagion effect. I think it's fairly unlikely. I think it's fairly unlikely at this point. So one of the things I am concerned about, though, is how depositors are going to interpret some of these results.
Mm.
Meaning, if I had $100 million at Silicon Valley Bank, and that was my main bank, I'm just going to pull my money from all small banks and go to the very, very large ones.
Mhm.
Okay. And that may be a terrible business decision, but we don't know. And so that's where I'm concerned that I think there might be a bit of an overreaction. From what I can tell, SVB, excuse me, was a very idiosyncratic issue because of the way they managed risk during an increasing interest rate cycle. So, but can it expose some other weaker financial institutions? It can. It can.
Mm. Yeah, that's really interesting, to kind of think about the shaking out of, how that could play out, and to reiterate your offer of like, hey, if you have questions, like reach out, like let's look, we can dig in to some of these, other companies. They are public companies, right? And so if they are, we can look, we can
Yeah.
dig in and see, yeah, how healthy are these other institutions? How are they managing risk? Like that's when you are a banking institution, that's your main priority, right? Is managing risk. Um, so what does this mean for the stock market as a whole? What do you see as, the next week, the next couple of weeks? How do you see this playing out um in broad strokes?
Broad strokes. One, I think you're going to see a lot of really good financial institutions get sold off pretty aggressively. Unfortunately, because I think they're being sold off many times some of these companies are being sold off for no reason, because their risk practices are much tighter, much more conservative than Silicon Valley banks or SVB. So I do think that as investors become more concerned with the health of financial institutions, it will cause a lot of downside volatility with some of those, the entire banking industry,
Mm.
which is too bad. But for patient investors, it may be a great time to look at some of these. But again, we are not overweight financials, so I'm not recommending or not recommending you buy or sell financial institutions right now. What I'm saying is there's going to be a lot of volatility in that area as regulators figure out what's going to happen with SVP over the next 6 weeks, and as investors search for the next weak link.
Mm.
If there is a long period of time, then it will be a very much of non-event. But if there are other banks that are weaker, that are that investors find, and you start hearing those whispers, then that could be accelerating the demise of those institutions.
Mm.
But again, they're not going to be the banks that off the top of your tongue, unless you live in their locale. They're going to be smaller.
And so the other question I have, so beyond, just the financial sector, which is, in most portfolios, that does tend to be a pretty big um, holding
Holding.
for most investors. What about like the tech companies? Do you see any knock-on effects for large tech, which has had a rough year already? Do you think that increases or changes anything in the tech sector?
Yes, it will change some things, but it won't change for the very, very large tech companies. It won't change much.
Mm.
But if you're a small startup or a small tech company that's, a small cap tech company that's based there, and your major banking relationship is there, that's going to be a difficult time for you to get through to get your funds. Okay. Now, I think they'll get a majority of their funds, but it's a timing issue. How fast does the FDIC work through this issue? And that during the next 4 to 6 weeks be a a volatile period as we get more news dribbling out about, you know, depositors getting recoveries. They're getting their money out. They're able to pay their employees and pay their vendors and operate in a normal fashion. For tech companies that uh, had a most of their money with Silicon Valley Bank, that is going to be a question mark for a bit.
Mm.
So those companies could come under volatility, which again it's it is what it is. But hopefully they're able to put together financing and sources of capital that they're able to exist during this uncertain period.
Mm. Well, thank you, Brad, for talking with me about this. It's all over the news right now, and so I know for my own clients and friends and people who have been asking me questions, I wanted to get your voice of reason and understanding of like a very deep understanding of risk in the financial markets. Um, I really wanted to get that perspective. So I appreciate your time. Is there anything else you wanted to share before we wrap up?
No, I think that we'll see SVB being sold by the FDIC to another entity. Um, and so it'll be interesting to see how that all plays out.
All right. Well, keep We'll keep you all posted with what comes up next. And if you have any questions that have come up from this episode, be sure to reach out to me at hannah@expansiveceo.com or hannah.chapman@x2wealthplanning.com or to Brad Haines at B.
It,
Haines,
yep,
Haines,
yep.
at juncturewealth.com. So all of that will be in the show notes. And thanks for listening. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.